We are talking logic today and not theory, which is Trump, dollar index. So today markets are reacting to micro rather than macro. And that's always a good market to have when you have markets which are in a sense governed by logic, governed by news, governed by earnings, governed by and not governed by sentiment, hope, assumptions, right or wrong. I don't know, but when markets get into this tailspin of they start reacting to every bit of macro thing which is happening in the world, it is not a good sign. But SBI numbers, I don't think there is anything wrong with those numbers. Stock will settle down. Similarly, Trent, expensive, nothing wrong with the numbers. So SBI numbers are not great, but stock is cheap. Trend numbers are fantastic, but stock is expensive, to put it very simply. Sunil Koul, global emerging market equity strategist with Goldman Sachs, joins us now. Good to have you back. Thank you for joining us. How are things with you?
Things are great, Nikunj. Hi, how are you? Good to be back.
But when are FIs coming back?
I think you want the global sentiment to improve a little bit before FIs can come back. As you started the show, I think today my market is trading micro as opposed to global macro. So let the global macro stabilize a little bit.
The government has decided to do what a year ago was unthinkable: a tax cut and giving money in the hand of taxpayers. I never thought I would ever write this headline after a budget. The headlines which I've written after 20 years, yeah, tax increase, surcharge going up, but it's the other way around. 1 lakh crore comes back into the economy. What kind of multiplier it could create?
Yeah, I think to think about that, Nikunj, it's important to think where could this money flow through, right? I think you're right in pointing out that you're putting like 30 basis points of GDP or basically 1 lakh crore in the hands of people. We think that money sort of gets divided or allocated to 2-3 things, right? So there will be some part of that would basically go into urban deleveraging. I think people who have been sort of under stress kind of borrowed in terms of personal loans, credit cards. I think there will be definitely some consumer deleveraging which will happen, which in turn should benefit some of these consumer retail-oriented lenders, right? Another, I think, pocket could be, I think, the high-end part of the of the consumption spectrum, the people who are earning more than 25 lakhs, let's say that. I think that will probably end up getting saved. I think it's the urban consumption where we think, let's say 13 million people in terms of tax filers, but there will be some dependents, some kids. Let's call it like 30 million people who are sort of getting a tax relief in here. I mean, we sort of think that 60 million is roughly the affluent consumption sort of basket in India. So you're seeing the bottom half of that 60 million, the 30 million, which are not sort of poor, but still kind of somewhat affluent, which have been sort of consuming this on discretionary consumption.
Oops, lost him there. Never mind. What do we have on the markets? Mindacop numbers, its auto ancillary numbers are at 65 crores versus 52, up 23% year on year. And you can see Mr. CS Shetty also, and he's the new chairman of State Bank of India. We'll be cutting across to that press briefing in perhaps a minute or so, but is Sunil back? I would give it a chance to see if the Goldman Sachs guest is back. SBI, we can of course cut in.
In 2025, global economy is being driven by a strong US economy, offsetting the weak euro area and China. As per the latest assessment, the IMF projects global growth at 3.3% both in 2025 and 2026, below the historical average of 3.7%. The global inflation has continued to soften and is expected to approach inflation targets for most of the central banks, albeit with a different speed across geographies. However, on the downside, the impact of trade wars on global growth and in turn on inflation remains uncertain at this stage. While the new US administration...
Okay, Sunil, we just lost you there. We want to perhaps, or you may want to take that point forward. 1 lakh crore comes back into the economy. How will that be spent?
Yes, so just very quickly, Nikunj, what I was saying is that I think part of that will sort of go into this consumer deleveraging, right? People have kind of taken credit card loans, personal loans. I think some of that will be spent there, and that should help some of the consumer retail-oriented lenders. I think part of it definitely is going into sort of discretionary consumption boost, kind of travel, so other discretionary categories, fashion, retail. And some of it will also sort of go into savings, especially I think with people with more than 25 lakh, which is probably the higher end of the consumption cohort, that will end up spending a little bit. So I think this entire 1 trillion INR, it probably doesn't, entire part of this doesn't boost consumption as it is, but it probably sort of gets divided into some of these pockets, as I mentioned.
Came out, the theme was don't buy build India stocks, which is Capex, infra, defense, railways, move to consume India stocks. Is there merit in thinking like that?
I mean, yeah, I think there is some merit to that, Nikunj, because I think if you just looked at, I mean, obviously from the budget, it's very clear that your allocations to large capex spending is roughly sort of flat as a percentage of GDP, right? Even I think allocations to roads and railways is almost sort of flat. Defense is a little bit 5% or so, and there is a consumption boost that we talked about. But I think if you just looked at the portfolios, right, over the last sort of 3-4 years, I mean, defense as a case in point, railways as a case in point. I mean, our sort of baskets or portfolios in those areas have run up like 300-400% in the last 3 to 4 years, right? And so I think what needs to happen is people will reorient some of their portfolios away from some of the very capex sensitive sectors more towards discretionary consumption categories, and that's how we are kind of set up in our allocations as well.
Now let's look at the numbers in totality. Capex is still expected to grow in 10%. I mean, it is in line with India's nominal GDP in and around plus minus 1%.
Yes.
Consumption will not grow at 10%. So if the Capex growth is higher than consumption growth, I wonder why everybody is talking about buying consumption stocks.
Yeah, so again, I think you have to look at it this way, Nikunj. I think within the 10% capex growth, which is obviously revised estimate on budget versus the estimate there, there's obviously flat allocations to some of the pockets. Railways is a case in point. I think highways is a case in point. Whereas I think there is slight, I mean, defense is also very moderate allocations. Whereas I think where allocations have gone into is money has been sort of given more towards states for doing sort of infrastructure plans. And I take your point because there will be some sequential improvement in capex given the underspend that has happened this fiscal year, right? So I think from a sequential perspective, you might see some spending coming back. But I think the broad point, and this is something we have been sort of saying for a while, is that gone are those days wherein you actually saw 30% plus capex spending during the last 3-4 years, and then the capex spending going forward will be more in line with nominal GDP, which is what we have been seeing in the last couple of years, sort of 10-11% in that sense. But if you look at how the portfolios have performed, you have seen significant outperformance, as I was saying, in some of those capex sensitive cohorts, whereas consumption as a category has lacked. So we do think that on a relative basis, at a very aggregate level, you would see some outperformance from the consumption cohorts compared to the capex sensitive sectors. Again, within consumption, it's a broad category. We don't think, as we discussed, staples benefit a lot from that. But some of the discretionary consumption categories, I think QSR is a good example in point that could do well. I think there is a lot of focus on tourism, travel. I think that would continue to do well. I think footwear and some of the other discretionary categories, durables for that matter, also we think could benefit. So again, I think there are very pockets of consumption, discretionary consumption categories that could relatively do better compared to the very heavy sort of capex, government capex intensive sectors that have done already well in the last many years. Obviously, they have pulled back over the last sort of 3 to 6 months, but compared to how much rally they had in the last 3-4 years, we think there is still chance for that reversion to happen, where consumption as a category will do better than infrastructure.
Divided on what is the right way to approach consumer staples. Can they get re-rated after budget?
Look, I think, again, maybe we sort of missed it at the earlier in terms of when we were talking about how will this money get spent in. So the if you look at the tax relief that's been given, that's given to roughly sort of 13 million consumers in terms of the relief there. If you add in the dependents and add in the kids in there, this is roughly, let's say, 30 million cohort. In our earlier work, we have sort of classified affluent India as the 60 million cohort, which is something that's been sort of driving a lot of the consumption in India. So what's happening is that within that 60 million, you're probably seeing the bottom half, the 30 million, where you are where you are giving the tax relief. That's not sort of poor consumer, so to speak. It's still somewhat affluent consumer, and they have been sort of consuming the discretionary categories. We think they will continue to consume, right? So there is not as much tax relief directly to the staples, but I think it's more in the sort of mass urban urban consumption where it is coming in from. For staples in particular, we do think, as we know, in the last couple of quarters, they've already seen volume growth improving. So I think we are seeing a gradual recovery in in rural consumption in general, and that should help staples. But the recovery would be very gradual. I think we already have had a decent sowing season, barring any kind of weather shocks. We might have a decent harvest as well. So all of that should incrementally be good for rural incomes. But from a budgetary standpoint, there is not a lot of support in that, and we think there is a gradual recovery in rural, which will continue to mean that staples should their volume growth should improve, and you could also see a little bit of pricing power come back, and so the profitability probably gets to kind of 10% earnings growth or so for the staples as a category. But does that necessarily mean that they outperform within the broader market? We think discretionary probably is a better bet than staples.
Within Capex, there are companies which are dependent on private sector Capex. There are companies which are dependent on government sector Capex. And if data is to be looked at, private sector Capex has not reached satisfactory levels. Government is doing all the heavy lifting. So is one better off buying into Capex themes which benefit from government? Could it be defense? Could it be railways? Could it be simply roads?
Yeah, I mean, as I said, I think within the broader sort of capex sectors, Nikunj, so we have been underweight cement, where we think I think you still have sort of challenges in terms of competitive intensity, but also kind of some pricing pressure. So cement is something we have been underweight. I think infrastructure, within infrastructure, where we are kind of more neutral, we have pockets of the broader industrials, airlines as a case in point, I think, which could do well. But I think sectors like um, infrastructure are very capex heavy, railways, roads. I think they can underperform in the current context. Is our sense. So we're kind of more cautious those segments.
It up with one final question, which is that what to your mind are the deserving P multiples for consumer stocks, given that we are growing at 6.5 to 7%, and what is the deserving P multiple for Capex stocks, considering that these businesses will not grow above 15-17% irrespective of the cycle?
Yeah, I mean, that's a great question, Nikunj. Look, I think historically there has always been kind of premium valuations to Indian consumer stocks. I mean, compared to anywhere else in the EM, and at the peak, and many of these consumer stocks, and you can't sort of broadly overgeneralize, but they were sort of trading at 50, 60, 70 times PE. Market itself at the peak in September, before we just downgraded it in October, was trading at 25 times the aggregate market. From there, I think we have seen a decent pullback in the market, close to 15% plus. But when you look across categories, including in consumption, you're seeing sort of 20% plus multiple deratings in in many of these stocks. So our sense is that you're getting to a level in aggregate terms where market is getting sort of more fairly valued. I mean, within that, I mean, for the headline market overall, we've sort of gone from 25 to 22 times PE, and our sort of fair value target is more like 21. But you have seen derating across categories, barring obviously financials, which were already cheaper, and IT. And so consumption has also seen seen a derating. And so I think in that context, we think the multiples are currently sort of more slightly above average, but not sort of super expensive. I think till India remains a broader consumption story, you still have consumption trading relatively sort of more expensive than the rest of the market. Because I mean, and when you talk about Indian consumption, this is not just kind of staple stocks, but you have sort of discretionary categories, you have the paint stocks, you have the consumers facing banks. That's all the broader consumption. And barring IT, a lot of the other India, lot of FI is still kind of engaged in the consumption story in India. And so it still will trade at a relatively higher multiple to the rest of the indices and rest of the consumer pack across the EM. So somewhere around sort of 30, 40 times P is still relatively okay compared to the broader market trading at 20 times.
Well, Sunil, appreciate your time and so glad you could join us. We take a break.